In today's video, what I wanted to share with you were the key fundamentals of what to consider when looking to invest in property and how to get started. The three areas that I will be addressing and speaking about today when looking to invest in property would be your goals and objectives, the key drivers that drive the property market, and capital versus cash flow, because a lot of investors obviously would love to have the benefits of both capital growth and a strong cash flow. So the first step when looking to invest in property is to really understand your goals and objectives. Every investor is going to have a different set of goals and a different set of objectives. So don't base what other people have and try to replicate that unless it's suitable for yourself as well. So what's really important to consider is your financial position. So you shouldn't just be investing in property just for the sake of it. It needs to really line up with what your financial goals are. But also the other part is to ensure that your personal and your lifestyle goals aren't affected by purchasing a property as well, because ultimately you want the asset to work for you. It needs to be an asset, not a liability. You don't want to obviously have the stress and burden of an investment property if it's not doing what it's meant to do for you, or if you're having to cut back on how much you spend in terms of enjoying life, traveling, eating out. And that's why it's important that the property actually coincides with your short-term and long-term goals. So property is a long-term asset. It's not something that you buy and you sell within a year or two, which you see some people do, but it's a long-term asset vehicle where most people hold the asset for at least 7 to 10 years, which is typically one property cycle. So the property from a short-term goals perspective should line up with what your living habits are, your expenses, your spending, making sure that that property and asset isn't impacting your lifestyle and financial position. But also when you're looking at it from a long-term perspective, you want that asset to continue to grow so that it's going to be a nest egg or something that you can utilize equity and growth to then further your wealth, and also maybe be an asset that's also going to produce income for your retirement. So really need to think about what that asset is for your short term, your now, as in your 1 or 2 years, but also what that asset's going to look like in 5, 7, 10 years time as well. Now, once you have your goals and objectives in place, now comes the fun part in terms of trying to understand which property or which location to invest in. And there are certain key drivers that really drive an area and an economy. And I've broken them down to 4 key areas that you should be considering when looking to buy property, whether it's for you, even if it's not investing, you're looking to obviously buy a place to live in for yourself. One main thing is also your family home is probably your biggest nest egg. So the first key driver to consider would be population growth. The second, infrastructure and investment. The third, employment and education. And the fourth, lifestyle and amenities. And I'll go through each one. Population growth. So what we've seen is that areas that have had strong population growth and demand over the number of years have also had a correlation in terms of property price increases. And the reason being is that as more people would like to reside in a specific area, the more pressure and demand there is going to be on housing in that particular market. So obviously, if there's no more infrastructure in terms of new houses, and there's only a limited supply of houses, and you've got this growing demand for it, you will see prices continue to move in an upward trend. Now, the other key consideration would be infrastructure and investment. So what we've seen also is that when there are government incentives and initiatives for new infrastructure and investment into, say, for instance, rail, town planning, new estates, and motorways, what this does is it actually provides people who reside in those areas better access to infrastructure and amenities. Now, a good way to find out where the government is spending money is to actually jump on to the local government websites. So, for New South Wales, you can jump onto the New South Wales planning portal, and they'll actually disclose all the local projects and how much they're actually spending, and also the timeframes in which these projects are expected to finish. That's a really good way to see where the government is actually spending their money and where they're investing back into the community. Now, the third key driver, employment and education. Obviously, everyone wants to be close to their workplace. No one wants to have to do, an hour and a half commute. Obviously, we've got the luxury and benefits now of potentially working from home, but not everyone does. So anywhere close to an employment hub is sought after. Now, the other area is education. school catchments for young families or families in general play a big part in terms of how property prices move or how they actually price. So what I've seen and what I've experienced is that typically areas with really good school catchments, obviously top 10 schools, say for instance in New South Wales, typically have more of a premium than other areas where they're not so highly ranked. And I've seen a lot of buyers pay a premium just to be within that catchment area. And to give you an example, Beecroft Public is a very, very sought after public school. I believe last year, everyone in the OC class made it to James Roos High School, which normally comes first every single year for the ATAR. Now, the fourth key driver to consider is lifestyle and amenities. Everyone's huge on fitness, parks, lifestyle, being close to amenities. That's a big thing now, and I completely get it. Obviously having a young family, you want to be, a few minutes to the local park, or, being able to pop in, grab a really nice coffee and just relax and chill. And also having good access to, pools, gyms, fitness centers. That's really a big part of living now, and obviously a lot of people understand that. And so you probably find that in a lot of newer states, they're big on obviously having a lot of green fields, a lot of parks, a lot of skate parks, and that's all part of the development infrastructure moving forward. So it is a big key driver. It's one of the big things that a lot of people look for when they are looking for property, is to understand how close they are to certain aspects and amenities, and obviously how that's going to impact their lifestyle. So it's important when you're looking for the right investment property to consider all these four key drivers. It's not to say you could be able to tick every single box off, but obviously the more you have within that specific area, the more you're going to find the properties and location will typically grow more in value compared to obviously neighboring suburbs. So definitely a good starting point to use when you are trying to pinpoint the right location to buying your investment property. Now we come to the last point that we obviously wanted to speak about in this presentation: capital versus cash flow. And look, every investor would love to have the benefit of a very strong property that grows in exponential capital growth, and also have a strong servicing capacity, so we're not having to fork out too much money on a weekly basis. Now, if we kind of take Sydney for an example, over the last 30 to 40 years, property prices have grown quite substantially where the rental yields have diminished and dropped. And that's, just due to the nature of the property market itself. So I guess what we need to understand is to really kind of look at your personal and financial position and try to understand what's actually really critical for yourself in this right moment. Are you looking for a property where capital is more important, or is cash flow still something that you need to have to be the overarching, goal within this investment property? So there's also a lot of strategies around, buying property, and you really need to pinpoint what's going to work best for you. Now, if we kind of look at each area, if you kind of look at capital is the area that's also going to help you move from one investment property to the next, because as a property grows in value, you can leverage off the equity to then use that as a deposit for the next property. Okay, but there could be a compromise in terms of how much yield you get. So there could be a shortfall in terms of how much rent you receive to the interest repayments and other expenses, which you may need to fund out of your own pocket. So that's what the trade-off that you need to obviously consider. Now, if we're looking at cash flow, some investors might be really, really, quite bullish on buying properties at a lower entry price where you're seeing yields of, say, 6%. And it's driving, a positive cash flow, which means that you're not having to kind of then look for, additional funds on a weekly basis to support the loan repayments, which is very logical, because no one wants to have to keep on pouring money into a property. But I guess the trade-off there, if you are buying entry-level properties and the cash flow and the yields are strong, there is that trade-off that you may not have substantial capital growth. And, over a 10-year period, you may only see a growth rate of, say, 2%, which is not going to be enough for you to then draw equity out to then purchase another property. So they're the considerations I would say to really think about when you're investing in property, is what strategy really lines up with your current position financially, lifestyle-wise, but also does it work well with your current short-term and long-term goals. Now, over the next couple of weeks, I'm going to do some more videos where we're going to break down different strategies that you could utilize which I feel that could work really well in terms of getting the benefits of both, where you can looking at properties where they're yielding well. There may be a shortfall, but it may not be as significant, but then the upward swing in terms of capital growth is very, very substantial, and we can look at ways in which we can manufacture that. So that's the strategies that we use for a lot of our clients, and I'd love to share that with you. So stay tuned for the next videos, and we'll be able to share that with you. Thank you for watching. See you later.